For those interested in finding potential multi-baggers, the types of companies that could potentially go up hundreds or thousands of percent over time, you might do well by looking at spin-offs. That's one of my favorite places to look at for potential multi-baggers. So if you ever see one, call it out to me. So what is a spin-off? If this is your first time, checking in or learning about it, a spin-off is when a public company spins off or takes a subsidiary and says, hey, this subsidiary is now going to trade as its own public company. This is a way of saying, casting a light on this specific asset and saying, hey, this should have its own value. What market value will the market give? And this is oftentimes a valuable thing to do when you have a money-losing asset that might be worth a lot because it's growing a lot. And sort of saying, hey, maybe we have all these prosperous operating units, but we have this one segment that the market's not valuing. Let's spin it off. Shareholders get shares in the spin-off, and then it just starts trading as its own entity. Now, why is this a potential source for treasure in the stock market? The reason why is that oftentimes when folks get their newly spun off shares, they go, wait a second, I don't actually want to own this. They don't do the research. They don't want to hear about it. Or maybe they're a forced seller. Maybe they're a large cap investor, and all of a sudden they get this spin off in a little rinky-dink company, and they go, I'm not interested in a sub $10 billion company, or we want to own dividends and this isn't a dividend payer. So you also have this dynamic with spin-offs where there's a lot of forced selling. And so usually within the first, let's say, few days to a few months to a first year, the returns for the spinoff can be interesting and certainly volatile. Well, you'll see typically some sort of capitulation where just shares get sold off as they're handed to the existing shareholder base that sort of says, we don't want to own this. So the question is, as IAC recently spun off Vimeo stock, or VMEO, just in the last few days, I'm wondering, is Vimeo a source of potential treasure? Is it a potential multi-bagger? If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. This is a no-hype, mission-focused channel to try to find those types of stocks that can potentially go up hundreds or thousands of percent over time. Let's do a quick dive or a deep dive into Vimeo. And so as we look at it, you see, what are they trying to do? What is Vimeo? Because honestly, a lot of people know about YouTube. I think a whole lot less knows about Vimeo, where it's about creating and editing videos, streaming live, recording it, managing a video library for collaboration, sharing these videos. Maybe you embed it on a website, measuring, having some sort of analytics to say, hey, who's watching it for how long? Then you can take these links, you can easily send them out to customers, make it so maybe you're making some sort of pitch or product demo so customers can see it. You can do a broadcast to an audience, and maybe this is for your advertising or just monetizing a product, letting people know this is what you do. So who's using Vimeo? The ticker currently is VMEO. And, they go through several examples. One example is Rite Aid. They do have several mega companies where they talk about, here it is, our first town hall was a pivotal moment. So this was something that was recorded effectively like a large Zoom, I would think about, but using Vimeo's recording software, where we reached more store associates than we had in a decade in in-person events. It's super interesting. They talk about MailChimp. My team is recording and sharing product demos internally. It adds a personal touch that you just can't replicate with email or chat room message. You're sharing something to and from internally in a company, and maybe you just make a quick video about it, so that way people go, oh, okay, this is really what's going on. It's an interesting approach. Certainly, given that some people do prefer emails, but it's a question, and I think this is the multi-billion-dollar question as you're going through all of this, is do you think video is sort of a growing platform, a growing tool set that more and more companies will need to have, want to have in the years and decades ahead? And, another example, Y7 Studio looks like a Pilates studio, where they talk about how video has transformed our business. We've grown our reach exponentially far beyond the four walls of our studios. Once again, taking something and looking at making videos, maybe live streaming it to their audience to make it easier for people to participate in classes. So what's actually driving this rise of video for businesses? And they try to break it off into two different segments, enterprise versus small, medium-sized business. So for enterprise, you have a secure video portal. This is all talking about Vimeo solutions. You can use, let's say, their portal. You make these videos for training and onboarding that you can send to customers, or that you can send to your employees saying, hey, this is what we're doing, this is how to use it, this is what we're supposed to do. Customer service videos, town halls, every 2 weeks you're meeting up, you're talking about what you're doing, and it's an exclusive, it's a secure video portal. And then maybe you want to refer to a prior town hall, so you have it all in one portal. You can easily control F, look it up. Video messaging, as we just saw with MailChimp, people sending messages to and from. Then for smaller businesses, maybe it's having a virtual event, hosting with potential customers, or sending out videos, or just having a place to store their videos. And this is it's really interesting, because a lot of people, as I already mentioned, think of YouTube. Surprise, surprise, you're watching a YouTube video right now. But the business model here is quite different, where it's about taking sort of a freemium model and ultimately converting users, and wanting to make sure you keep the users interested in the end product. Whereas you look at something like YouTube, which is an ad-driven business model primarily, and an ad-driven model is sort of saying, hey, yeah, this video you're watching now, it might be interesting, but let's redirect you to something else. That goes directly against whatever these businesses are interested in. They do not want an ad-driven platform to be hosting their videos. So that it is a niche, I would argue, that Vimeo is addressing. But how big is this potential market? They think it's about a $70 billion opportunity that they're looking at. And look, they're putting up some interesting numbers. 54% growth in the fourth quarter. I think the first quarter 2021 was closer to 60%. They have some attractive unit economics at 4.8 times lifetime value to customer acquisition cost. They're seeing their enterprise customers are inherently growing, paying more for their services, paying 13% more year over year for their services. And it's effectively a very recurring, very, I'd say, stable business model with 80% plus subscriptions or subscribers on an annual plan. So that does create sort of a predictable revenue growth. And when you think about whether or not it's that small and medium-sized business versus those enterprise customers, enterprise is a faster growing stake in this total business. Enterprise is only about 25% of their revenue now. While Vimeo has been around for some time, their pivot to focus on enterprises and businesses really has only happened in the last few years. And they've won some major customers like SoftBank, Intuit, Spotify, Amazon, SAP, and New York Times. So they are really making a push, saying, look, video is a critical tool for businesses to use, whether or not it's internally or for customer acquisition. And so if you're going to be embracing this as a important medium in the future, Vimeo is going to be providing that one-stop shop for your video solutions. And so how does that translate into their financials? And you can see their end subscribers are up 24% year over year. The amount that their average revenue per user is also up nicely, and that's why their revenue growth in 2020 was up 44% in 2020. So that's some nice growth, but clearly a COVID bump, which we'll talk about in a minute. They do have some attractive margins, 69% gross margin. They think over time they could be over 75%. Still effectively unprofitable or break even, negative 14 million in adjusted EBITDA in 2020. So I'd say slight loss. But they are projecting over time, if you get to scale, 20% plus EBITDA margins. We'll talk about how this plays into their valuation in a minute. Longer term, they think over the next 5 years they could be looking at 30% plus CAGR in terms of growth, which is a combination of 15% annualized end subscriber growth and 15% pricing power, or raising prices, or the customers are just using their solutions more. So this is an interesting case. It's effectively saying, hey, what you just got in this spinoff is arguably a high growth company, 30% plus growth company over the next, through 2025, let's say, and it could be very profitable over time. This is what people think it should be valued on, so how we should think about it. So what about the valuation as we look at all of this? And then, for me, it's just a quick plug. If this is your first time tuning in, please make a point of subscribing. If you enjoy learning about these potential multi-baggers, types of stocks that could potentially go up hundreds or thousands of percent over time. If you want to follow my personal journey, go to unrivaledinvesting.com, or first week of the month, I call out my full portfolio, and also during the month, I call out one new potential multi-bagger or type of idea that I think could potentially go up hundreds or even thousands of percent over time. And very least, if you're already a subscriber, I do appreciate that thumbs up. Let's keep going into this valuation as we look at it. And so as I look at this valuation for Vimeo, so first, the stock price has already fallen a little bit. It's now around $44 a share. For the dilution, you do need to consider the shares and units that have vested so far. So that gets to a little about 180 million units or shares outstanding, which gets to a little under $8 billion market cap for this business. you can see that they've grown from 160, 196 million, then 283 million in revenue. They did have an acceleration in revenue in 2020 to 45% growth. That's up from the 22% or 23% in 2019. So that is something to keep in mind. Like, well, wait a second. Pre-COVID, you were only growing at 22, 23%. Is it really sustainable for you to be growing at 30% plus in the years ahead? So that is a little bit of a red flag, something to think about. Then, you think about their growth in 2021. I'm penciling out somewhere between 40 and 60%. That might be too high. That might be too low. I personally think this is probably going to be on the high side. Their first quarter was about 60%, but that probably had a beneficial COVID, comp or comparison. And so I just wonder if they're going to be able to put up numbers that are like this. Let's give them credit for that figure. Let's do a range of 40 to 60% growth for 2021. What are their margins longer term? Management saying longer term their EBITDA margins are 20%. So I'm saying, hey, let's give them even more credit. On the low side, 20% operating profit margins. That's what I'm assuming here, to 20 to 30% range. And then what's the growth perspective, that you think about in the ensuing years beyond 2021? And so I'm trying to give management credit here of 30 to 40% growth in the ensuing years. And then what's sort of the end multiple that you're thinking about 5 years out? I assume 20 to 35 times. And looking at all this, it just isn't that compelling from a risk reward. So it wouldn't surprise me, even though I thought that this might be some hidden treasure, it wouldn't surprise me to see this continue to get sold off, just as investors sort of saying, well, wait a second, this is a very rich asset, very richly priced for something that's not really hyper growth and could face the potential of a dramatic slowdown to about 20% annualized growth. Now keep in mind, this is just a framework. This is a hypothetical sort of valuation framework. Of course, the stock price could go way higher or way lower than what I'm penciling out, but this is what helps me sleep better at night, and it's also a North Star for me. Just sort of say, well, wait a second, if I see something that's dramatically off from this, I'm just not going to be interested. I like it when I'm using a framework like this, and in my low side, I'm penciling out something like, oh, there's still 50% upside in my low case. Here it is, I'm saying there's 50% downside here. And one smell test that investors could always consider is, what would you consider their earnings to be this year in 2021 if they had their optimized margins, if they already reached their what could be their full potential margins this year, and what's sort of that multiple right now? And that sort of gets to the 75 to 130 times, which for arguably 40 to 60% growth this year is just super rich sort of multiples. The type of valuation that can get you really excited is when you're looking at sort of this implied earnings multiple based on optimized margins. They're not there. When you're looking at an implied multiple of, let's say, 50 times and you're growing at 100%, that's a lot more interesting. Or it's an implied multiple of 20 times and you're growing at 50%. That's a lot more interesting. This multiple just isn't doing it for me. They might be addressing an interesting niche, so I got to give them, credit for what they're doing. But at the end of the day, they might be able to create an unrivaled value proposition with what they're doing. Saying, hey, we're not going to focus on this ad-driven market. We're going to focus on creating tools that are helpful for small businesses. So they might be able to continue growing at this high pace. They might be able to deliver, but it's just being priced in already. Unless there's some sort of, transformative acquisition that they do that meaningfully changes the economics or their growth prospects, I just don't see it at this point. That said, not all stocks are overly priced. I have called out Alibaba as one company, in a separate video where I thought, hey, the risk reward here is actually much more compelling. And I also, for my Unrivaled Investing Journey subscribers, for my potential multi-bagger for May, it was a company trading below liquidation value that I think has 2 to 3x upside over time. So those are the types of plays that I'm looking for in this market. So if this video, talking about Vimeo, the spin-off, learning about spin-offs, looking for that hidden treasure in spin-offs, if that's been helpful for you, please make a point of subscribing. If you're already a subscriber, I do appreciate that thumbs up. Thanks so much for watching.